Welcome back to the Deep Dive. Our mission, as always, is to slice through the complexity and really deliver the essential insights you need to understand the biggest structural shifts happening in the global economy.
And today, we are tackling a big one.
A huge one. It's a massive, complex, and I think it's fair to say, a highly contentious stock that sits right at the intersection of, well, everything. Climate change, national security, and of course the AI boom. We're talking about GE Vernova, ticker GEV.
Yeah, and this is not just another industrial spinoff. GEV is a newly public company spun off from the old General Electric conglomerate back in April 2024.
Right.
And when you actually look at their operational footprint, you realize this company is, and I don't use this term lightly, systemically critical.
Okay, so define that for us. What does that mean in real terms?
Well, by pretty conservative estimates, GEV's installed fleet, so that's the gas turbines, the generators, the reactors they build in service, that fleet generates approximately 30% of the world's electricity.
30%. Just
Wow.
let that number sink in for a second.
Right. It's staggering.
I mean, that number alone, that defines the scale of the company's defensive moat. We aren't just talking about, a cyclical upswing here. We are positioning GEV right at the epicenter of what the entire market is now calling the electrification supercycle.
And that's the central thesis. This is a fundamental, multi-decade structural trend. It's being driven by these massive, just undeniable forces.
Yeah, what are those forces?
The supercycle thesis is really the foundation of the whole investment case. It's the convergence of three non-negotiable trends. You've got the push for decarbonization, one, the urgent need for grid modernization after decades of underinvestment, two, and third, and this is the real kicker, this entirely new massive demand shock coming from generative AI and hyperscale data centers.
And GEV provides the tools for all three.
They provide the physical tools for all three of them. Exactly.
Okay, so we have this massive infrastructure monopoly, unparalleled market penetration, and it's generating recurring service revenue that, frankly, a lot of pure-play software companies would kill for. That sounds like an absolute must-own, almost like a utility.
It does sound like that.
And this is the tension that's going to drive our entire deep dive today.
The tension is entirely about valuation and expectation. The market has figured this out, and it's figured it out with astonishing speed. GEV's stock has run up, just sharply. We're talking gains of 70 to 80% year-to-date in 2025.
Wow.
It's trading at what we call a significant scarcity premium. And that's because, frankly, there's almost no other pure-play, large-cap, liquid way for investors to get this specific exposure.
Exposure to grid modernization and firm power generation.
That's it. It's a unique asset.
And when you pull up the financial metrics, that scarcity premium becomes, well, it's stark. It's almost alarming. We are looking at a forward price-to-earnings ratio, a PE, sitting somewhere near 46 times consensus 2026 earnings estimates.
46 times. And just to put that in perspective for you, that's the kind of valuation you'd normally see on a software company, a high-growth tech disruptor.
Not a heavy industrial infrastructure company.
Definitely not. So the market isn't just pricing in success. It's pricing in flawless, optimized execution. It's pricing in what we'd call the Goldilocks scenario, where every single segment performs perfectly and every ambitious margin target is met on time, every time.
Okay, so our mission today is clear. We need to dissect that tension. We are going to go under the hood of GEV's three very distinct businesses: power, electrification, and the very volatile wind division. We'll analyze the macro shifts, and then we'll try to determine if the underlying quality of this business is durable enough to justify paying a hyper-growth multiple for what is, at the end of the day, a heavy industrial company. So let's unpack this. Let's start at the beginning with the foundation. This whole thing is built on a massive corporate divorce, right? We have to understand the mechanics of the spinoff, because that's what created the financial resilience that GEV has today.
It really is. The separation wasn't a voluntary nice-to-have. It was a strategic necessity to unlock value. For years, the energy businesses, gas power, grid, wind, they were all held captive inside the old General Electric.
And they were burdened by what analysts call the conglomerate discounts.
The conglomerate discount,
Yeah.
exactly. And this wasn't just a valuation issue, it was operational. You had these high-growth, capital-intensive businesses competing for capital against the legacy debt-heavy remnants of GE Capital and those immense pension liabilities that just haunted the parent company for decades.
So the spinoff was like taking the chains off.
Precisely.
Right.
It was unshackling the assets to let them be valued on their own merit, totally free from all that historical baggage. And the resulting financial structure is, I would argue, GEV's single biggest competitive advantage today. The source material we looked at uses the term fortress balance sheet.
And that's not just marketing speak.
No, it's not hyperbole at all. I mean, how does it compare to the industry standard? It's night and day. As of Q3 2025, GEV reported a cash balance of $7.9 billion.
Okay, that's a huge number.
It is. And critically, zero financial debt on the industrial balance sheet. Now, that's before the financing for the Prolec acquisition, which we'll get to, but still, a net cash position is invaluable in this sector.
So how does that help them win business?
Well, just look at their primary European competitor, Siemens Energy. They've had a really rough go of it. We're talking severe liquidity crises needing billions in government-backed guarantees, basically state aid, just to assure customers and secure major contracts.
So if you're a utility signing a 20-year deal, you look at GEV's balance sheet, then you look at Siemens. It's not really a choice.
It becomes a very simple decision. It's all about counterparty risk. GEV has the opposite problem of Siemens. They have a ton of cash, which gives them this immense buffer for M&A, for R&D, for weathering any short-term operational hiccups. They've de-risked themselves in the eyes of their customer.
And importantly, the spinoff provided a true cleanse of all those legacy liabilities that sank the old GE stock for decades.
A complete cleanse. The pension obligations, the complicated insurance stuff, all of that was overwhelmingly kept by GE Aerospace, the other spinoff. GEV emerged as this much cleaner, more focused company dedicated purely to the physics of power generation and delivery.
Which has to simplify the story for big institutional investors.
It does. They love clean balance sheets.
But a great balance sheet only matters if the people in charge are disciplined. The old GE was kind of famous for empire building and these confusing cross-subsidies. This new board, it seems intentionally built to avoid that.
That's a key takeaway. The board is not just about financial expertise. It's about deep operational discipline that's specific to the industrial and energy sectors. Take the non-executive chairman, Stephen Angel.
Right, he was the former CEO of Lind.
Lind Defecek, one of the most efficiently run industrial gas companies in the world. He brings a mandate for operational rigor, cost control, supply chain efficiency. That's absolutely vital in this kind of low-margin industrial manufacturing world.
And the independence is striking. 9 out of 10 directors meet the independence criteria.
Yeah, that minimizes the chances of that old insular club mentality that can get big companies in trouble. And beyond that, the management incentives are really tightly aligned with creating shareholder value.
How so?
CEO Scott Strazek's compensation, for example, is heavily weighted toward hitting very specific, measurable metrics. Free cash flow conversion and EBITDA margin expansion.
So it's not just about growing revenue at any cost.
Exactly. It signals a shift away from that historical GE weakness-chasing top-line growth and toward maximizing profitability and efficiency. If they hit that crucial 14% EBITDA margin target by 2028, Strazek gets paid, and so do the shareholders. It's a direct link.
That structural foundation seems really solid. So now let's pivot to the engine that's fueling this astronomical valuation, the electrification supercycle, and specifically AI's role in it. You mentioned a violent reversal in electricity demand. Can you unpack that for us?
For the better part of a decade, the consensus view among analysts was that electricity demand in developed economies would be flat. Maybe up a tiny bit, but basically flat.
Because efficiency gains would offset population growth.
Right. That assumption has been utterly, completely invalidated by AI. The supercycle is defined by a fundamental mismatch. You have demand absolutely exploding while supply is constrained.
What is it about AI specifically that flips the switch so drastically?
It's all about computational density and the cooling needed to handle it. Think about the physical infrastructure you need for generative AI, for large language models. It requires these immense, densely packed, hyperscale data centers.
Okay.
We had an analogy in the intro. A standard data center rack might pull, say, 10 to 15 kilowatts of power. That's already a lot.
Yeah.
But an AI-dedicated rack, one that's specifically for processing these huge workloads, we're talking 40 to 100 kilowatts, sometimes even more.
So that's up to 10 times the power load in the same physical space.
It's an exponential curve, not a linear one. And as a result, major utilities across the U.S. and Europe are now revising their 10-year load forecasts upward by 50, even 100%.
And that's all from data centers.
entirely due to data center demand. And this isn't just any demand, it's mission critical. If a tech giant's AI cluster goes down for a minute, they lose millions. They cannot tolerate interruptions.
And that, you said, requires firm power.
Precisely. You cannot run a critical AI cluster entirely on solar panels and wind turbines, no matter how much battery storage you have.
Why not?
Batteries are fantastic for short-duration stuff, smoothing out the grid for a few minutes, maybe a couple of hours, but they are not cost-effective or physically scalable enough for multi-day outages or, a week of cloudy, still weather. So the tech giants and the utilities are aggressively demanding generation assets that run 247. That's baseload or firm power.
And today, in 2025, firm power means gas turbines.
It does. And this has totally shifted the strategic narrative around natural gas. Gas is no longer seen as just a bridge fuel to get us to 2030. It's now being viewed as a destination fuel for 2030, 2040, and maybe even beyond.
So the demand for GEV's gas power equipment is surging.
It's running at levels we haven't seen since the boom in the early 2000s. But this time, it's driven by fundamental secular demand from the companies with the world's most powerful balance sheets, the hyperscalers and the top-tier utilities.
But doesn't that inherently clash with long-term net zero carbon goals? If a utility buys a 30-year gas turbine today, aren't they just locking in carbon emissions for 3 decades?
And that is the essential technological hedge that GEV offers. It's a critical selling point. Their most powerful and efficient models, the H-class turbines, are explicitly marketed as hydrogen-ready.
What does hydrogen-ready actually mean in practice?
It means a utility can install the gas turbine today to meet that urgent AI load, and then in 10 or 15 years, when green hydrogen infrastructure or carbon capture becomes commercially viable, they can retrofit the turbine to burn a lower or even zero carbon fuel source.
Without having to scrap the entire multi-billion-dollar asset.
Exactly. This technological flexibility is a critical selling point. It allows utilities to balance the short-term need for reliability with their long-term climate mandates. They're providing an insurance policy for decarbonization.
So if firm power for AI is the first leg of the supercycle, what's the second?
The second leg is the physical grid infrastructure itself. The grid is the choke point, the whole electrification of everything. The shift to EVs, to heat pumps, industrial process electrification, all of that is piling onto an aging transmission and distribution network in North America and Europe that was built for a 20th century world.
Right, a world with one-way power flow from a big plant to your house.
A completely different world.
Right.
So connecting new generation, moving power efficiently, handling peak loads, it all requires massive multi-trillion-dollar infrastructure upgrades, and that directly benefits GEV's electrification segment.
Okay, let's drill down into those segments, starting with the power segment. You called this the financial bedrock, the cash engine that subsidizes everything else.
It is GEV's strategic core. The gas power business is the crown jewel. It generates the bulk of the profitability, and that stability comes from one thing, the installed base.
Which you said is an intangible asset?
An intangible asset unlike any other in the industrial world. We are talking about 7,000 heavy-duty gas turbines globally running every single day.
It sounds less like a factory floor and more like a software subscription model.
That is the perfect analogy. The actual equipment sale, selling the turbine itself, is often a low-margin deal. It's almost a loss leader.
A cost to acquire the customer.
Exactly. The real value, the prize, is securing the long-term service agreements, the LTSAs. These are high-margin, mandatory recurring contracts that typically span 15 to 20 years. They cover parts, inspections, maintenance, software updates.
It's an annuity stream.
It's an annuity stream that guarantees cash flow for 2 decades after you place the equipment.
And this is where that AI demand shock becomes a profit accelerator.
A huge accelerator. Think about the life cycle of these turbines. Previously, a gas plant might have been used as a peaker plant, only running during high demand spikes in the summer, for instance.
So the maintenance interval would be longer.
Much longer, but now AI demand is forcing utilities to run these exact same plants as baseload 247.
Right.
Higher utilization means higher operational hours. Higher operational hours shorten the mandated maintenance intervals outlined in those LTSAs.
Which means GEV gets to recognize that high-margin service revenue much, much faster.
Correct. The maintenance cycles compress, the high-margin parts get ordered sooner, and the cash conversion cycle just speeds up dramatically. So the secular change isn't just driving new equipment sales, it's intensifying the profitability of the existing colossal installed base they already have.
And what about the competition? I mean, this is a global oligopoly, right? How is GEV positioned against the other giants like Siemens Energy and Mitsubishi Power?
It's a very tight race, but GEV has clearly gained ground in the last couple of years. They held about 34% of the megawatt orders in the heavy-duty space in 2023 and 2024.
That's a strong position.
It's very strong. And more importantly, they dominate the fast-starting, more flexible aeroderivative turbine space. Think of a jet engine converted to run a power plant. There they have something like 63% market share.
And why is that?
Utilities see them as the provider with the lowest execution risk and, as we discussed, the strongest balance sheet. When you're a utility committing billions of dollars to a 30-year asset, counterparty risk is everything. GEV is seen as the safe pair of hands.
Okay, so gas power is the reliable cash machine for today. But the nuclear segment, that seems to be the long-term, high-potential call option for the 2030s.
Nuclear is the ultimate future firm power solution, particularly small modular reactors, or SMRs. And GEV, through its GE-Hitachi Nuclear Energy joint venture, is positioned in a really unique way.
How so?
Their strategy is one of extreme technological conservatism, and that, counterintuitively, turns out to be a massive competitive advantage in the highly regulated nuclear sector.
So they're not trying to invent some brand new exotic technology.
Not at all. And that's the key to their BWRX 300 design. It's not a science experiment. A lot of their competitors are chasing these novel, complex designs with molten salts or liquid metal cooling systems.
Which sounds exciting, but also very risky from a regulatory standpoint.
Incredibly risky. You have to prove brand new thermodynamics, new material science, and get it all through an entirely new regulatory framework. GEV's design, the BWRX 300, is just a simplified 300-megawatt version of their existing licensed and proven ESBWR reactor.
So they're using components that regulators already know and have approved.
Exactly. It uses standard uranium fuel rods, established components. The regulators, like the NRC in the U.S., are already familiar with the fundamental physics and materials. This drastically reduces the technological risk, and crucially, it minimizes the regulatory timeline and cost.
Which is the single biggest barrier to entry for nuclear power.
It is, and we are seeing that low-risk strategy translate directly into commercial traction right now.
Where are we seeing that?
Well, in Canada, Ontario Power Generation, OPG, is already preparing the site for the first BWRX 300 unit at their Darlington facility. They're targeting operation by around 2029.
And in the U.S.?
In the United States, the Tennessee Valley Authority, the TVA, one of the largest public power providers, has explicitly selected the BWRX 300 for its construction permit application at their Clinch River site. These are not just pilot projects, these are multi-billion-dollar commercial deployments.
So if this global nuclear renaissance actually happens, driven by the need for 247 carbon-free power, this SMR business could add tens of billions to GEV's long-term backlog.
It has transformative potential because when you win a nuclear contract, you're not just selling a reactor. You are locking in 60 years of highly regulated, specialized, high-margin fuel supply, maintenance, and software services.
Another installed base mode.
A huge one. If GEV can capture a dominant share of this nascent SMR market and their low-risk approach suggests they have a great shot, that invisible moat expands dramatically into the next century.
Right, let's transition from the reliable cash engine to what you call the undisputed growth engine, the electrification segment. This segment seems to be riding the immediate violent wave of grid modernization, and it's delivering some explosive results.
This is the fastest growing part of the franchise, and yeah, the numbers are astonishing. We saw revenue growth of 35% year over year in the third quarter of 2025.
Now, 35% growth in an industrial segment is phenomenal.
It's incredible. And crucially, given the corporate focus on margins, the segment's margins are also expanding quickly, hitting 15.1%. This segment provides the literal physical and digital backbone for the entire energy transition.
Why is the pace so urgent? Why is the growth so fast right now?
Because the existing infrastructure is, to put it bluntly, falling apart and the demand is immediate. Imagine trying to run a fire hose through a garden sprinkler system. That's the problem we have. We're connecting massive offshore wind farms, industrial solar arrays, thousands of distributed energy resources like rooftop solar and batteries, all while millions of EVs and heat pumps are plugging into distribution networks that were built in the 1950s. The grid simply lacks the capacity and the intelligence to handle it.
And GEV focuses on two key tech areas to solve this: the high-voltage physical gear and the digital layer. Let's start with the physical infrastructure, specifically high-voltage direct current, or HVDC.
HVDC is indispensable. Standard alternating current AC is great for local distribution. But when you need to transmit huge blocks of power, say 2 gigawatts over hundreds or thousands of miles, AC becomes really inefficient due to energy losses.
And HVDC fixes that.
It dramatically reduces those losses. This makes it feasible to connect remote generation, like a massive offshore wind farm hundreds of miles off the coast, directly to a densely populated city.
You mentioned GEV is one of only 3 Western companies that can deliver the complex VSC systems. Why is that specific technology, VSC, such a critical moat?
VSC stands for Voltage Source Converter. Older HVDC tech was complex and pretty rigid. VSC is the new standard because it allows for much finer, faster control over the power flow. And most importantly, it allows for the creation of multi-terminal DC grids.
Okay, what does that mean?
It's essential for the future. You might have 3 different offshore wind farms all feeding into one DC line with connections that branch out to 3 different cities. That level of complexity is incredibly difficult to engineer, which is why the barrier to entry is so high.
So GEV isn't just selling cables, they're selling highly complex proprietary control systems.
That's right. The intellectual property is the key, and it's translating into exploding order books. We saw evidence of this in Europe, where they secured these huge framework agreements with major transmission operators like TenneT.
And a framework agreement means they're locked in for years.
For a decade, often. They're essentially locking in pricing and capacity with GEV, which ensures a pipeline of multi-billion-dollar projects.
And beyond the hardware, there's the software layer.
The software is the intelligent overlay that manages all this new complexity. Digital grid software, things like Advanced Distribution Management Systems, ADMS, and Distributed Energy Resource Management Systems, DERMS, turns the grid from a static network into a dynamic, intelligent one.
And that's a recurring revenue stream.
An incredibly sticky, high-margin recurring revenue stream. Because once a utility integrates GEV's ADMS to manage millions of smart meters and distributed assets, switching to another provider becomes nearly impossible. It's too disruptive.
Now let's talk about the strategic move that really underlined GEV's aggressive positioning here, the Prolec acquisition. This deals with the transformer bottleneck, which is causing global infrastructure nightmares.
It is the ultimate supply crunch. Transformers, especially large power transformers or LPTs, are these essential passive components that step voltage up for transmission and back down for distribution.
And they're hard to make.
They're complex to manufacture, they're heavy, they're difficult to ship, and the demand explosion has led to lead times just extending dramatically from a typical 12 months to, in some critical cases, over 3 years.
3 years. So multi-billion-dollar grid projects are grinding to a halt globally because they can't get transformers. That must give the manufacturers immense pricing power.
Unquestionably. And GEV chose this precise moment, October 2025, to announce the acquisition of the remaining 50% stake in their Prolec GE joint venture for $5.3 billion. This was a strategic masterstroke, driven by both necessity and opportunity.
So what was the critical logic there? Why pay over $5 billion to buy out a joint venture they already co-owned?
Full control. First, it consolidates the entire margin stack. So instead of splitting profits, GEV now captures 100% of the earnings from arguably the most constrained supply chain bottleneck in the entire grid buildout. And second, and this is just as important, it grants them full control over capacity expansion decisions. GEV can now prioritize capital investment to rapidly increase output at Prolec facilities. They can meet their own massive backlog commitments without relying on external, unreliable supply chains.
That seems like a high price tag, though. I mean, $5.3 billion in 2025, with interest rates where they are, that's a significant capital deployment. Was the price justified?
The justification is in the immediate financial and strategic acceleration it provides. Prolec is a phenomenal business. It operates at very high EBITDA margins, around 25%.
Wow. Okay.
So consolidating those earnings will mathematically accelerate the electrification segment's already high margin profile. It helps lift the overall corporate average much faster toward that crucial 14% target by 2028. Management essentially traded a big chunk of their cash for guaranteed high margin earnings in a constrained market.
So they're vertically integrating not just to save costs, but to capture margin and secure delivery certainty for their customers.
Precisely. In the electrification supercycle, the ability to deliver on time is the ultimate competitive moat. And controlling the transformer supply chain is how GEV secures that moat.
Okay, so now we have to address the elephant in the room. If power is the cash engine and electrification is the growth engine, The wind segment, and specifically offshore wind, is the primary source of volatility, friction, and frankly, skepticism for investors. We really have to separate this into two distinct businesses, onshore and offshore.
That distinction is absolutely vital. The onshore wind business, which focuses on land-based turbines, has gone through a painful but necessary restructuring. For years, the whole industry was just chasing volume at totally unsustainable margins.
Right.
GEV management came in and enforced a value over volume strategy. They drastically reduced their global footprint, they exited low-margin markets, and they simplified their product portfolio, focusing heavily on their workhorse 3 mW Sierra platform, primarily for the lucrative North American market.
It sounds like a difficult operational process, closing factories, layoffs, but it's yielding financial results.
It has. After years of bleeding money, the onshore business returned to positive EBITDA in late 2024 and has maintained profitability through 2025. And a key driver of this newfound financial health is a brilliant strategy focused on repowering.
Okay, explain the financial advantage of repowering compared to a brand new installation.
Repowering means GEV goes to a wind farm they might have installed a decade ago, and they upgrade the aging turbines with new, far more powerful blades, nacelles, modern software, sometimes tripling the energy output.
Okay, but the key is what they reuse.
The key is they reuse the existing foundations and towers. Foundations and civil works are one of the biggest fixed costs in any wind project. By reusing them, GEV drastically reduces the overall project cost and time for the customer, while they capture exceptionally high margins on the equipment upgrade itself.
And that high-margin model is clearly working.
It is. In 2025 alone, they secured over 1 gigawatt of repowering orders in the U.S., just leveraging their existing installed fleet. They also landed their first major international repowering deal in Taiwan, proving this higher-margin service model is exportable. It's making the onshore segment a much more stable, capital-light business today.
Unfortunately, the success of onshore is completely overshadowed by the chaos, the execution failures, and the margin dilution plaguing offshore wind. And this is an industry-wide crisis, right? It's not just a GEV problem.
It is absolutely an industry-wide crisis. Offshore wind is where the true execution risk lies. The entire industry has struggled massively with scaling up these huge novel technologies, specifically the 15-plus megawatt class turbines like GEV's Haliade-X.
So what went wrong?
Inflation, supply chain disruptions, and just the sheer difficulty of transporting and installing components the size of skyscrapers have resulted in massive financial write-downs across the board. Vestas, Siemens Energy, GEV, they have all suffered immensely.
And GEV had a highly visible, very painful incident that really crystallized this execution risk in the public eye.
The failure at the Vineyard Wind project in July of 2024 was catastrophic for GEV's reputation. A blade on one of their massive Haliade-X turbines fractured dramatically, scattering fiberglass debris onto the protected beaches of Nantucket.
And the cause was a manufacturing defect.
The root cause was eventually identified as a manufacturing deviation at their LM wind power facility in Canada, which implies a systemic quality control issue during their big production scale-up.
That's not just a financial risk. That's an immediate political and regulatory headache, especially in the U.S., where offshore wind is still fighting for public acceptance.
Absolutely. The fallout was swift and measurable. GEV had to suspend operations, conduct a massive, expensive reinspection of about 150 blades that were already in the field, and then pay a $10.5 million settlement to the town of Nantucket. It was a tangible, front-page example of the immense operational liability in these cutting-edge yet unproven technologies.
So given that severe risk, what is management's plan to finally stop the bleeding in this segment?
The strategy is defensive and, frankly, ruthless. It's known as the burn-off thesis. Management has explicitly signaled that they are stopping all aggressive, low-margin bidding on new offshore projects. Their focus is 100% on execution.
On burning through the existing loss-making backlog.
Exactly. The projects they signed before the 2022 inflationary peak.
Can we quantify that drag? How big is that loss-making backlog?
It's estimated to be around $3 billion remaining. Now, that's small compared to the total $119 billion corporate backlog, but it carries deep negative margins, which dilute the profitability of the entire wind segment.
So the only way out is through?
The only way out is through. The mathematical completion, the burn-off of these challenge contracts is the only mechanism expected to bring the entire wind segment toward break-even in 2026. If that burn-off is delayed, or if they find more manufacturing issues that require more remediation costs,
then that 2026 break-even target immediately slides.
It slides, and it poses a serious threat to the overall corporate margin trajectory. This is the single highest execution risk GEV faces today.
All right, let's try to pull these three disparate segments together. The high-margin power base, the hyper-growth electrification engine, and this volatile wind risk, and see how they fit into GEV's ambitious financial roadmap. We know the CEO is incentivized to hit margin expansion, and management has laid out a clear path to get there.
That path is the entirety of the bull case, and it requires aggressive managed turnaround. They're projecting adjusted EBITDA margin expansion from around 5.8% in 2024 to a solid 8.9% in 2025, and then leaping to a long-term goal of 14% by 2028.
14%, that number is the holy grail. It's what the market is pricing in at 46 times earnings today.
It is.
But how do they get there? I mean, how do you jump from 5.8% to 14% in 4 years? For a massive industrial company, that seems almost implausible.
They're using three primary interconnected levers. The first is operational efficiency. They're running a major internal lean transformation program that's targeting $1 billion in annual structural cost reductions across the portfolio.
Okay, so cost cutting.
Cost cutting, yes. The second is volume leverage. As the gas turbine and grid equipment factories operate closer to full capacity because of the supercycle, the fixed costs get absorbed more efficiently, which boosts incremental margins.
And the third lever is the positive mix shift, where the high-margin parts of the business simply grow faster than the low-margin parts.
That's the most potent lever of all. The rapid high-margin growth of electrification, remember, 15.1% margin, plus the 25% from Prolec and the financial dominance of power services, which consistently operates above a 20% margin, that naturally pulls the corporate average up.
So as those high-quality segments grow faster than the legacy low-margin wind equipment business, the dilution risk from wind just subsides over time.
That's the plan.
But that all relies heavily on the quality of the backlog. I mean, a record $119 billion backlog is great, but is it full of profitable work?
The visibility is excellent, and critically, the quality of that backlog is systematically improving. Those legacy, low-margin offshore wind contracts are now being worked off, the burn-off we talked about, and they're being systematically replaced by higher-margin grid modernization orders and long-dated, high-margin power services contracts.
So this improving margin in backlog is what gives investors confidence.
It gives them confidence that the 2028 target is structurally feasible as long as they execute flawlessly.
And that profitability is translating into robust cash flow.
Absolutely. GEV is guiding for free cash flow, FCF, of $3.0 to $3.5 billion for 2025. And their target is 100% conversion of free cash flow to adjusted net income. That signals elite capital efficiency, which is vital for a company that was, in its old life, notorious for poor cash management.
That strong cash flow generation suggests the company is moving into a new phase of maturity. It's shifting from intensive capital deployment to capital return.
It's the ultimate signal of confidence for management. They're transitioning from paying for heavy restructuring to actively returning cash to shareholders. In December of 2024, the board initiated a substantial $6 billion share repurchase program and authorized a quarterly dividend of 25 cents per share.
And starting a dividend and a major buyback, that sends a powerful signal to the institutional world, doesn't it?
It absolutely does. It broadens their investor base, attracting more stable, income-oriented institutional funds. And beyond that, maintaining an investment-grade credit rating is non-negotiable for them. It's a prerequisite for bidding on these major 30-year utility contracts. Utilities demand counterparty stability.
So strong fundamentals. Now let's go back to the unavoidable tension, that 46 times 2026 PE ratio. We've established the bull case, but we have to introduce the friction. Is this just irrational exuberance tied to the AI trade?
That is the core question. GEV trades at a massive premium. For comparison, a high-quality industrial peer like Eaton, which also benefits from data center exposure, trades around 30 times earnings.
So a full 16 turns higher.
Right. The difference is that GEV is the purest of pure plays on the heavy-duty grid infrastructure. So investors justify that 46x multiple with the scarcity argument. They're not just pricing 2026, they're pricing in the probability of GEV hitting that 14% margin target and then compounding earnings aggressively through 2030.
But the bear case raises some very serious quantitative friction points about those expectations.
They do. We've seen analysts, including from Rothschild Redburn, initiate sell ratings, calling that 14% long-term margin target implausible for a company with this operational mix, especially with the residual drag from wind.
So what's the core of the bear argument?
It centers on the risk that the current surge in gas turbine orders is a cyclical peak. that it's a temporary panic buying phase driven by data centers scrambling for capacity, rather than a structural foundation that lasts indefinitely.
Okay, so what happens if GEV misses that 14% target? What if they stall out at, say, 10% EBITDA margin?
That is the catastrophic scenario for the valuation. If margins stall at 10%, or if gas turbine orders roll over sharply after 2025, the market would quickly re-rate GEV to align with traditional high-quality industrial multiples, maybe 20 to 25 times earnings.
And a compression of that magnitude, from 46x down to 25x, would result in a sharp 30 to 40% downward correction in the stock price.
A huge correction, irrespective of the underlying business quality. The valuation leaves absolutely no margin for error.
And we can't ignore the external risks, which are always magnified when a stock is priced for perfection like this.
Major external pressures. First, regulatory risk. Trade conflicts and tariffs are a persistent threat. GEV has publicly estimated that potential tariffs could have a negative impact of $300 to $400 million on their bottom line in 2025 alone. That is a significant hit.
And the connection to the broader AI trade is a risk factor in itself.
It's a critical correlation risk. GEV's premium valuation is inextricably linked to the optimism around generative AI. If that AI hype bubble were to crack, or if the hyperscalers signaled a slowdown in their massive data center build-out.
For whatever reason, a technical hurdle or an economic downturn.
Right. GEV would suffer a sharp correction due to that correlation, even if the grid modernization trend itself remained intact. When the valuation is this high, external sentiment risk is just amplified.
This has been a fascinating dive into a company that's really operating at the apex of technological and structural change. Let's summarize the two extreme outcomes that are currently battling for dominance in GEV's share price.
The bull case requires everything to go right, but the potential payoff is enormous. The electrification supercycle proves to be longer and stronger than anyone expects, driving unprecedented demand. The SMR opportunity fully materializes, securing their future in firm power, and the electrification segment margins exceed 20%, aligning with best-in-class pure plays.
And if GEV executes that flawless vision,
the stock compounds aggressively, it could potentially push towards $750 a share and beyond.
and the bear case, the ultimate friction point.
The bear case hinges on execution failure and margin compression. The win-losses persist beyond 2026, management fails to hit that critical 14% margin target, and the market concludes that gas orders have peaked cyclically.
And the multiples compress.
The multiples compress rapidly back toward industrial averages, maybe 20 to 25 times. In that scenario, the stock falls sharply, possibly back toward the $400 mark.
So what is the final actionable takeaway for you, the learner, regarding this high-stakes infrastructure play?
GE Vernova is an undeniably high-quality franchise. Its strategic relevance to global decarbonization and the urgent needs of the AI economy is unparalleled. It's run by a disciplined management team, and it has that fortress balance sheet. But the current price, that 46 times multiple, leaves absolutely zero margin of safety for execution slip-ups, whether they're technical failures in the wind division or a miss on the margin expansion goals. New capital deployment should be cautious. I think investors should probably wait for inevitable volatility, maybe a correction driven by external sentiment or a specific quarterly miss in the wind segment, to accumulate shares aggressively at a lower multiple.
That brings us to our final provocative thought for you to chew on. When we look at that massive premium, that high value, it's essentially tied to an asset that isn't even recorded on the company's traditional balance sheet. It's an invisible asset.
That's absolutely right. The true foundation of this premium valuation isn't the physical cash, it's not the factories, or even the new equipment orders. It is the massive, reliable, and high-margin installed base, those 7,000-plus gas turbines. That's what guarantees high-margin service revenue for decades, and its profitability is currently being accelerated by the very secular trend of AI. This invisible asset is the bedrock that allows the market to apply that scarcity premium today, demanding not just perfect execution, but eternal reliability.